The essentials of retirement taxation and tax planning. Now pay very close attention because Uncle Sam wants his cut of your retirement savings. Hello, my name is Michael Graff and I represent Pro Income, Professional Retirement Income Planning in Walpole, Massachusetts. Now the purpose of this short presentation is to help you better understand how your retirement income and assets will be taxed after you retire. Now the numbers on your retirement account statement certainly seem clear enough. But what your statement does not show is the portion of those funds that you will be paying in taxes to the IRS. So the amount you will pay in taxes and when you will pay those taxes is something you may be able to control. But the key to controlling when and how much you will pay starts with understanding how your money will be taxed now and during retirement. So, how is money taxed? Let's get started. First of all, there are the three tax buckets. Now the first bucket is the taxable bucket. Funds in here include bank savings, money market and CD accounts, stocks, bonds, and mutual funds. Now, the funds in this bucket are taxed now and will be taxed on an annual basis. Then there's the tax-deferred bucket. This includes employer-based retirement savings such as 401ks, 403bs, simplified employee pension plans, and simple IRAs. In addition, there's traditional IRAs, annuities, and real estate. All of these accounts have characteristics for deferring taxes that will be paid later. Then there's the tax-free bucket. This includes Roth IRAs, municipal bonds, and life insurance with a cash value. These accounts are taxed never. Now it's also important to know there are two income tax categories: ordinary income tax and capital gains tax. Now under ordinary income tax, there are income tax brackets, which start as low as 10% and go as high as 39.6%. Now income from all of these types of accounts, IRAs, 401ks, 403bs, SEPs, simple IRAs, bank type accounts, bonds, short-term capital gains, Social Security, if it's subject to taxation, pensions, non-qualified dividends, and finally wages. Again, income from all of these types of accounts are subject to taxation based on a person's established tax bracket. Then there's capital gains tax, which are based on short and long-term tax rates. Now, as we've already shown, short-term capital gains rates are the same as ordinary income tax rates, based on a person's particular income tax bracket. Long-term capital gains rates are taxed at three levels: 0, 15, and 20%. Now, in order to qualify for a 0% tax rate, then your income would need to be taxed under the 10 or 15% ordinary income tax brackets. 15% capital gains tax rates are based on 25, 28, 33, and 35% ordinary income tax brackets. And if you're in the highest tax bracket, then your long-term capital gains will be taxed at the highest rate of 20%. Now, accounts included under here include stocks and mutual funds, bonds, and qualified dividends. It's also important to note that Roth IRAs, municipal bonds, and life insurance with cash value are typically not subject to ordinary income tax or capital gains tax. So let's talk about retirement tax planning. Now, it's important to understand the distinction between total income and taxable income. Now, total income includes all income, which are typically from these categories: retirement account distributions such as IRAs and 401ks, dividends, pension income, income you earn from wages, certainly Social Security, and finally interest income. Now, taxable income is the portion of total income that is subject to taxation, either by ordinary income tax or capital gains tax. Now, retirement tax planning is about reducing taxable retirement income in order to maximize total retirement income. Let me say that again. Retirement tax planning is about reducing taxable retirement income in order to maximize total retirement income. By reducing your taxes, we increase your income. Some of the retirement tax planning strategies to consider include tax bracket management, Social Security tax planning, retirement income timing and sequencing, Roth conversions, and finally, retirement asset reallocation. Now, for more information on your tax planning options, please call me, Michael Graff, at 781-248-7344, or email me at mgraff@proincomeplan.com. Thank you for watching, and I hope to hear from you.